Watch this space. Last year saw record high capital being raised from listings of special purpose acquisition companies, known as SPACs, and the ASX is keeping a close watch on the SPAC phenomenon and how it could play out in Australia. By Gary Anders. Article begins. In financial circles, they are known as special purpose acquisition companies, or SPACs, shell entities with no active business operations that have been listed on a stock exchange. With a stockpile of cash raised from investors, the sole objective of the venture capitalists behind each SPAC is to seek out a privately held company that can be acquired and then taken public. Compared to a traditional initial public offering, IPO, the process for listing a SPAC is typically less arduous on a regulatory level and therefore quicker and considerably cheaper. The benefit for investors is that they can tap into the investment skill sets of the people behind the SPAC, right at the ground floor, and potentially receive a strong capital return over time. However, this is a waiting game, because the management behind a SPAC generally don't have a specific target in mind when their takeover vehicle is listed. They have about 2 to 3 years to complete an acquisition following the SPAC's IPO. If they don't, they must liquidate the company and return the capital raised to the other investors. The bulk of SPAC listings to date have been in the US. Last year, a new record was set, with $83 billion in capital being raised from investors across almost 250 IPOs. That US dominance is rapidly changing, however, with the Euronext Amsterdam having emerged as the favoured stock market for European SPAC listings. The London Stock Exchange is also considering relaxing its existing rules to encourage an increase in UK SPAC listings. For now, the Australian Securities Exchange, the ASX, is holding back. It prohibits stock market listings of what it terms cash box companies, where cash makes up more than 50% of an entity's assets. Yet while there won't be any SPAC listings on the ASX in the near future, we are likely to see an increase in mergers and acquisitions in Australia led by foreign-listed SPACs. Australian entrepreneurs Patrick Grove and Luke Elliott recently listed the Catcher Investment Corp SPAC on the New York Stock Exchange. The listing raised $300 million. They are indicating that they are actively seeking a technology company acquisition in Australia. The volume of capital being raised by SPACs in the US and Europe will invariably generate more M&A activity in the Australian market, says Nicole Pedler, partner at law firm Herbert Smith Freehills, specializing in M&A and equity capital market transactions. This in itself may create potential complications for some Australian companies, should they be targeted by a foreign-listed SPAC. In addition to having to negotiate the pricing and terms of the takeover deal, the companies will need to be in a compliance-ready state in order to transition into being a company listed on an international stock exchange. The transition process is called de-SPACing, and on average takes only about 3 to 5 months from announcement to completion. Nicole Pedler says, where, if they wanted to get IPO ready in Australia, they'd be thinking about the ASX listing rules. They actually need to get familiar with the environment of being listed predominantly in the US. They need to have their accounts in order and to have enough of a track record of having the right type of accounts and a level of diligence around those to be able to be de-SPAC ready. They'll also need to have the kind of board and governance that allow them to be very quickly listed as well. For most companies, they'll need to go through a process of having their accounts reopened and refashioned to ensure they comply with offshore accounting standards, notes Pedler. The ASX says it is examining the SPAC phenomenon closely. Our focus is on achieving the best outcome for the Australian market and for local investors, says Max Cunningham, Executive General Manager of Listings and Issuer Services at the ASX. We've had approaches from parties about our preparedness to consider changing or waiving our anti-cash box rules to facilitate SPAC transactions. However, the history of cash box companies in Australia has been poor, and there are important scale, regulatory, and commercial differences between the Australian and US markets. Nevertheless, the structure for SPACs is evolving. We are doing work to consider the opportunity carefully. We'll listen to the market and take a cautious approach, says Cunningham.